SoFi Technologies stock is trading live right now at $17.21, up 20 cents or roughly 1.18% on the day. The stock opened the session at $17.08, touched an intraday high of $17.45, and dipped to a low of $16.97 on a volume approaching 10 million shares in the morning session. While a 1% gain on a Tuesday morning might look like routine noise on a daily chart, looking under the hood reveals a market caught in a massive tug-of-war. Wall Street is pricing this company like a cyclical consumer lender facing credit headwinds, while retail investors and tech bulls view it as a primary financial super app taking market share from legacy institutions. That disconnect between market expectations and operational reality is where the real story lies. The prevailing market belief around SoFi stock is straightforward. Many institutional traders still lump the company into the high-risk fintech category alongside early special-purpose acquisition company booms that eventually flamed out. The surface narrative says that higher interest rates cut into loan origination volumes, that personal loan defaults could rise if employment softens, and that digital banking apps face too much competition from standard platforms like Fidelity Wealth Management or Schwab Intelligent Portfolios. Investors watching the stock pull back from its 52-week peak of $32.73 assume the growth story has slowed down, but when you look at the actual balance sheet and underlying metrics, the reality looks completely different. SoFi is no longer just an unchartered fintech middleman taking origination fees. It is a full-fledged chartered national bank generating consecutive quarters of net profitability, pulling in billions in sticky retail deposits, and diversifying into technology infrastructure through Galileo and Technisys. To understand why today's price action at $17.21 matters, you have to look at the immediate technical and tactical setup in the market. The stock has been consolidating in a tight band over the last few weeks as Wall Street prepares for the company's upcoming second quarter earnings report scheduled for July 29th. Trading volume has stayed well above 80 million shares daily on average, demonstrating that institutional interest remains massive despite the pullback from last year's highs. Short interest remains elevated, which means every piece of macroeconomic news or rate sentiment shift triggers aggressive short covering and rapid intraday spikes. When mega-cap market movers like Tesla stock, Apple stock, or Nvidia stock experience volatility, money managers often rebalance out of growth equities and high-beta financial names, creating temporary downward pressure on SoFi that has little to do with its fundamental banking performance. At the same time, the broader backdrop for retail finance and wealth management platforms is shifting rapidly. Everyday investors are no longer content leaving their cash in traditional checking accounts that pay zero interest. They want integrated options for self-investing, high-yield cash management, and seamless trading tools. Many people who started out looking for basic investment help or exploring top investing sites ended up comparing traditional accounts like a Fidelity brokerage, Fidelity IRAs, or an individual brokerage with modern digital platforms. While legacy giants rely on Fidelity mutual funds, Fidelity ETFs, or their desktop-centric Fidelity trading platform, younger account holders prefer mobile-first solutions. They look at options like Robinhood stock trading on the Robinhood app, checking out Robinhood investments, exploring Robinhood crypto, or opening a Robinhood cash management account to buy Robinhood fractional shares. But SoFi recognized early on that offering fractional shares and stock trades was only one piece of the puzzle. By building out SoFi Invest alongside its lending and banking services, the company created an ecosystem designed to capture every stage of a user's financial life. Whether someone wants SoFi Active Investing to trade individual equities, prefers an automated hands-off option like the SoFi Robo-Advisor, or wants access to SoFi ETFs and general SoFi stocks, the goal is to keep capital inside the ecosystem. On the desktop and mobile interface, the SoFi trading platform competes directly for users who might otherwise open an Interactive Brokers account, deal with complex Interactive Brokers fees, or use the Interactive Brokers platform and Interactive Brokers trading tools for direct market access. While Interactive Brokers stock trading caters heavily to active global traders, SoFi targets the mass market consumer looking for a single hub for borrowing, saving, and wealth creation. Comment below how many shares of SoFi stock you currently hold in your portfolio and what average price you are aiming for this year. To appreciate how SoFi reached this inflection point, it helps to look back at how its business model evolved. The company originally built its brand by offering student loan refinancing to high-earning graduates. That focus gave it access to a high credit quality customer base, but it also exposed the business to massive regulatory changes when federal student loan payment freezes were put in place years ago. Recognizing the danger of relying on a single lending product, leadership pivoted towards obtaining a national bank charter, which was completed in early 2022. That single move altered the structural economics of the company. Having a bank charter allowed SoFi to hold deposits directly, dramatically lowering its cost of capital compared to non-bank fintech lenders that rely entirely on expensive wholesale funding markets. Today, the core engine of the business relies on three major segments: lending, financial services, and the technology platform. The lending side still generates substantial net interest income through personal loans, student loan refinances, and home loans, but the financial services division, which includes high-yield checking and savings, credit cards, and SoFi Invest, has grown into a major revenue driver. By offering competitive interest rates on deposits, SoFi converts casual app users into full primary banking members. Those direct deposit relationships supply the bank with low-cost liquidity, which can then be deployed into high-yield personal loans or held as capital reserves. Meanwhile, the technology platform segment operates as an enterprise back-end provider, processing transactions and providing cloud banking solutions to other institutions globally. When you weigh market expectations against financial reality, the contrast becomes stark. Critics frequently argue that online investing and online investment apps face cyclical risk if consumer spending slows or if federal interest rate adjustments narrow net interest margins. They point to competitive pressure from discount brokerages and self-serve platforms, arguing that retail investors can easily move their capital to invest online elsewhere. However, SoFi's cross-selling capabilities tell a different story. Once a member sets up direct deposit to qualify for premium yield on cash, the friction to switch to another bank increases dramatically. That high retention rate allows SoFi to lower customer acquisition costs over time, a metric that traditional fintechs struggle to manage. Looking ahead, the future outlook for SoFi stock hinges on several critical catalysts and potential risks. In the short term, all eyes are on the upcoming Q2 2026 earnings release. Consensus estimates project revenue climbing past $1.1 billion for the quarter, supported by steady expansion in total member accounts and net interest income. If management delivers another beat and raises full-year profit guidance, the current price level around $17 could serve as a solid base for a retest of higher valuation multiples. Key growth drivers include the continued expansion of fee-based loan platform services, where SoFi originates loans for third-party institutional investors without holding the credit risk on its own balance sheet. This capital-light revenue stream provides high-margin income that appeals directly to Wall Street analysts looking for quality earnings. However, risks must be factored into any balanced analysis. Macroeconomic headwinds, such as persistent inflation or potential spikes in unemployment, could lead to higher charge-off rates in the personal loan portfolio. Furthermore, if overall market volatility declines or retail trading activity slows down across all major platforms, transaction-based revenues in brokerage services could see a temporary dip. Regulatory changes surrounding capital adequacy requirements for regional and medium-sized banks could force SoFi to hold more reserve capital, slightly compressing return on equity metrics. Investors evaluating where to place capital must weigh these sector-wide risks against SoFi's demonstrated ability to grow top-line revenue at double-digit rates while expanding GAAP net margins. In closing, the current market pricing of SoFi stock reflects a classic clash between short-term macro sentiment and long-term business performance. Investors who focus solely on daily market fluctuations or broad fintech headwinds miss the structural transformation taking place under the hood. SoFi has evolved from a niche student loan lender into a profitable chartered digital financial institution with a growing tech platform and a highly sticky deposit base. While short-term volatility volatility will persist alongside broader tech and financial sector swings, the gap between market expectations and fundamental reality presents a compelling case for investors who track operational metrics over daily noise. Understanding that balance is essential for making informed decisions in an evolving digital banking market.